The Rigas family built a cable empire, then looted it for personal gain. In the annals of corporate fraud, few stories illustrate the corrosive power of unchecked familial ambition as starkly as the collapse of Adelphia Communications. This wasn't just a company failure. It was a saga of a multi-billion-dollar enterprise, built from scratch, systematically plundered by its own founders, the Rigas family, leading to a spectacular implosion that reverberated through the financial markets. John Rigas, the patriarch, started Adelphia in Coudersport, Pennsylvania in 1952. His vision was simple: bring television signals to rural communities that couldn't receive broadcasts. From humble beginnings, stringing cables himself, he cultivated a reputation for hard work and community involvement. For decades, Adelphia grew steadily, expanding its reach, acquiring smaller cable operators, and eventually becoming the fifth-largest cable provider in the United States. By the late 1990s, Adelphia was a publicly traded titan, a symbol of American entrepreneurial success. John Rigas remained at the helm, surrounded by his sons, Timothy, Michael, and James, all holding key executive positions. This family control, however, would prove to be both Adelphia's strength and its ultimate vulnerability. The lines between corporate assets and personal wealth began to blur, almost imperceptibly at first. Then, with increasing brazenness, the core of the fraud revolved around two primary mechanisms: undisclosed off-balance sheet loans and the direct misuse of corporate funds for personal enrichment. The off-balance sheet loans, amounting to billions of dollars, were guaranteed by Adelphia but used to finance ventures and stock purchases for the Rigas family's private entities. This debt, a significant liability, was deliberately hidden from investors and auditors. Imagine a company taking on massive liabilities on behalf of its executives' private dealings, yet never telling its shareholders. This systemic deception meant Adelphia's financial statements presented a misleadingly robust picture, making the company appear far healthier than it actually was. Investors, relying on these falsified reports, continued to pour money into what they believed was a sound investment. Beyond the hidden loans, the Rigases treated Adelphia's coffers as their personal piggy bank. Reports later revealed lavish spending: $13 million for luxury condominiums in New York City, a private jet for family use, golf course memberships, even financing a professional hockey team, all paid for with Adelphia funds, justified under the guise of corporate expenses. The sheer scale of the personal expenditures was staggering. The family had Adelphia pay for their personal security, their cell phone bills, the use of company cars, and even the construction of a golf course on land they personally owned. These weren't small, isolated incidents. They were part of a pervasive culture where corporate assets and personal assets were indistinguishable. The unraveling began in early 2002. Persistent questions from analysts about Adelphia's complex financial structure and the off-balance sheet entities started to gain traction. The Securities and Exchange Commission, or SEC, initiated an informal inquiry. The pressure mounted, and the carefully constructed facade began to crack under scrutiny. In March 2002, Adelphia shocked the market by disclosing $2.3 billion in off-balance sheet debt. This admission sent the company's stock plummeting. The immediate aftermath was chaotic. Investors lost faith, creditors panicked, and the media descended upon the small town of Coudersport, eager to uncover the full extent of the deception. John Rigas and his sons, Timothy and Michael, resigned from their positions in May 2002. Just a month later, in June, Adelphia Communications filed for Chapter 11 bankruptcy protection. It was one of the largest bankruptcies in U.S. history at the time, leaving thousands of shareholders devastated and erasing billions in market value. The Department of Justice soon filed charges alleging conspiracy, securities fraud, and bank fraud against John Rigas and his sons. The indictment detailed how the family had systematically looted the company, presenting a damning account of corporate malfeasance. The trial began in early 2004, drawing significant public attention. During the trial, prosecutors meticulously laid out the evidence: forged documents, hidden accounts, and a paper trail demonstrating the systematic siphoning of funds. The defense attempted to portray John Rigas as an aging, benevolent patriarch unaware of the financial intricacies, but the sheer volume of evidence against the family proved overwhelming. In July 2004, John Rigas and Timothy Rigas were convicted on multiple counts of conspiracy, securities fraud, and bank fraud. Michael Rigas was acquitted on some charges, but convicted on others. James Rigas was acquitted of all charges. The verdict sent a clear message: Even founders of successful companies are not above the law. John Rigas, then 79, received a 15-year prison sentence. Timothy Rigas was sentenced to 20 years. Michael Rigas received a 10-year sentence. The sentences were a stark reminder of the severe consequences awaiting those who betray public trust and manipulate financial markets for personal gain. The family's once proud legacy was irrevocably tarnished. The Adelphia scandal, alongside Enron and WorldCom, became emblematic of an era of corporate greed and accounting fraud that shook investor confidence. These high-profile cases led to significant legislative changes, most notably the Sarbanes-Oxley Act of 2002, designed to improve corporate governance and accountability. The Rigas family's downfall serves as a cautionary tale. It highlights the dangers of insufficient corporate oversight, especially in family-controlled businesses where the lines between personal and corporate interests can become dangerously blurred. The trust placed by shareholders and the public was systematically violated, with devastating consequences for all involved. Adelphia eventually emerged from bankruptcy in 2005, its assets largely sold off to Comcast and Time Warner Cable. The name, once synonymous with a community-focused success story, became a byword for corporate malfeasance. The countersport community, which had once celebrated the Rigas family, was left to grapple with the betrayal. John Rigas was eventually granted a compassionate release from prison in 2016 due to declining health, passing away in 2021. His sons, Timothy and Michael, also served substantial portions of their sentences. The human cost of the fraud extended beyond financial losses, impacting reputations, families, and a legacy that could have been one of enduring pride. The Adelphia communications fraud remains a stark reminder that even the most well-intentioned beginnings can be corrupted by unchecked power and greed. It underscores the critical importance of robust corporate governance, independent oversight, and unwavering ethical standards in the business world, regardless of who is at the helm. Explore another story of ambition's dark side next.